Alright, Jim Schultz here from my Finance 512 class. I wanted to continue with our discussion from the Chapter 10 and 11 material. Last time we talked about duration, and this time I want to talk about a topic called accrued interest. The duration video was pretty detailed. We went pretty deep into that concept. The accrued interest stuff is going to be much simpler, much easier to apply. So let's go ahead and get going. Before we get into accrued interest and what it is and how to find it and all those things, the first thing you need to recognize is that bond prices essentially have two prices associated with them. When you look at a bond's quote, something that you've already learned in your previous studies, the number that you see staring back at you, 970, 1100, 1080, whatever the number is, that is referred to as the flat price for that bond. Well, bonds also have what is referred to as an invoice price. And the difference between the flat price and the invoice price is the accrued interest associated with the bond. In other words, if you were going to put up a mathematical equation, and I'll go ahead and add it here to the sheet, the invoice is equal to the flat plus the accrued interest. And you'll see this in your textbook too when you complete your reading assignments for these chapters. But I wanted to go ahead and add that in there for completeness purposes. So we understand what a flat price is. We have a vague understanding of what an invoice price is. But what is the accrued interest? Well, the accrued interest basically works like this. So we already know that bonds pay coupons to their investors. And we also know that bonds typically pay coupons to their investors on a 6-month basis or semi-annually. So suppose that I owned a bond and I was midway through a coupon period. In other words, suppose I was paid a coupon like 3 months ago and I'm going to have another coupon payment coming my way in another 3 months, approximately. If I sold that bond that day, I'm actually the rightful owner of the first 3 months of that coupon that's coming in 3 months. Because think about it, right? If you get a coupon payment on, let's say, January 1st and July 1st, which are equidistant from each other, they're about 6 months apart. If I sell that bond in March or April or May, well, I was the rightful owner of that bond. I assumed all the risk associated with that bond from January 1st until the date that I sold it in March, April, May, whatever. So accrued interest takes into account, hey, you should receive a fraction of that coupon payment because you were the owner of that bond for some fraction of time within that coupon period. That is what accrued interest is. And so here's a very brief example. And much like I said I would do with the duration stuff, I do plan on adding another video to go through a duration problem and another video to walk through an accrued interest problem as well. So I understand that since we're not in the classroom for these topics, they're a little bit harder to grasp. And so I want to put you guys in the best possible position to succeed. So I'm going to make sure that I walk through at least one problem explaining kind of each step. But here's a very brief example. So a bond pays a $30 coupon every 6 months. There are 182 days in the coupon period, so approximately half of the year. You hold the bond for the first 35 days of that period before selling it. That means that you are the rightful owner of that bond for 35 of those 182 days. So you should receive that fraction of the next coupon payment. And that's exactly what you see down here with accrued interest. Accrued interest is simply you take the coupon payment and you multiply by the fraction of time that you owned that bond for that coupon time period. And this comes out to $5.77. And so if you looked at a bond, if this bond's quote was $9.60, right? So you look online or you look in the newspaper or whatever, and this bond that you own is worth $960. That is the flat price. But when you go to sell that bond, you're going to be able to collect both the flat price plus the accrued interest that you rightfully deserve, that you rightfully own, having taken on the risk of that bond for 35 of the 182 days in that coupon period. So the invoice price associated with that bond is going to be $960 plus $5.77 for a total of $965.77. So that is it. That is all there is to accrued interest. As I said, it's a pretty simple concept, and I really tried to give you guys a pretty thorough explanation of how this relates to bond pricing and how it manifests itself within selling a bond after you own it for some period of time. So I really hope this video was helpful, and I will see you guys next time.